Hi, I'm Dylan Kelly, a mortgage broker with Dominion Lending Centers, and I've been a broker since 2015. In today's video, I'll be walking you through strategies to qualify for a larger mortgage with A-lenders in Canada. A-lenders offer lower interest rates, so that's what we're going to focus on in this video. We're not going to cover things like having a strong cosigner. That's something you already know might help. Instead, we're going to dive deeper into actionable tips that you might be able to consider to help you out. Let's get started. Before diving into the tips, let's first talk about how lenders determine what you qualify for. It's really not a crazy equation that's too hard to understand. If you're putting less than 20% down, your application goes through mortgage insurers like CMHC. They use two key debt-to-income ratios. The first being gross debt servicing. This is your monthly housing costs, including mortgage payments and property tax, as well as heating, and 50% of potential condo fees if it's applicable to the property, divided by your gross monthly income. Repeat, before they take the taxes off, your gross income if you're employed. For example, if your gross income is $10,000 a month and your housing cost is $3,600 a month, your GDS would be 36%. The max allowed for GDS through the mortgage insurers is 39%. So in this case, you would be in line. Total debt servicing, or TDS, includes your GDS costs, so the property that you're purchasing, as well as your existing debt payments like credit cards, car loans, student loans. So if you have an extra $600 a month in the above case, your TDS would be 42%. For insured mortgages, the maximum GDS is 39%, as we discussed, and the maximum TDS is 44%. However, if you're putting more than 20% down, there's often more flexibility. Some lenders allow up to 50% for GDS and TDS, depending on your credit and financial profile. To find a baseline, download my Mortgage Toolbox app, which gives you a good starting point for what you qualify for. But remember, it's just a baseline. Okay, now that we know how lenders calculate your purchasing power, let's talk about ways to increase it. The first is income. And let's start by this. I'm not going to be telling you to ask your boss for a raise. That's pretty obvious. A higher income that way would help. That's not the point of this video. Instead, some tips here for you. Provide full documentation when getting pre-qualified. Give your mortgage broker, like myself, not just your job letter and pay stub, but also your tax history. Many people think their salaries or guaranteed hours is what we can use. But in fact, if you've been at the company longer than 2 years, we look at 2 years T4 slips, and if there's bonuses or overtime in that period, we can actually use that income. Include additional income sources on your application. Childcare benefit, Canadian pension plan, old age security, private pensions, long-term disability, and assistance programs like AISH can often also help you. Support payments like alimony and child support might also count towards your income as well. We can also include maternity leave income. If you're on maternity leave, we can use your pre-leave income as long as there's a confirmed return to work date. We would get your employer to write a letter just saying you're returning to work, and it's that easy. We can use your full income. Self-employed income. If you're self-employed, some programs allow us to gross up your income. For instance, if your net income is $100,000, but you're a sole proprietor with many write-offs, we might be able to, gross it up to $115,000 instead. Make sure you talk to a broker and have full income documents. Next, let's talk about credit. A higher credit score definitely helps, but there's more to consider when increasing your purchasing power. Pay down debt strategically. Lenders focus on monthly payments more than total balances. You should really focus on revolving debt. Paying off line of credit or credit cards typically has a bigger impact than loans like student loans or auto loans. Revolving debt is more flexible, but is also more costly in the eyes of the lender. For example, a $10,000 credit card balance might only require an $87 minimum payment on your actual statement, but lenders calculate 3% of the balance, which makes that $300. That $10,000 credit card balance being used as a $300 payment will actually reduce your mortgage qualifying by about $50,000. Smaller balances and higher payments is also something we want to look at. For loans near the end of the term, paying off the remaining balance can drastically improve your purchasing power. I've seen cases where a $4,000 auto loan that's almost paid off in full has an $800 payment, which wipes out about $100,000 of mortgage qualifying. Make sure you're looking at the smaller term loans before the revolving debts. Make sure you talk to a broker and have them assess what you should do to maximize your purchasing power. Remember, $10,000 extra down payment will likely do less for you than $10,000 towards debts. Make sure you're paying off the right debts, not only to save you interest, but to increase that purchasing power. Down payment and assets do matter. Having 20% down does not only avoid mortgage insurance, but also gives you access to more flexible lending options. Beyond that, net worth matters. If you have liquid assets such as RSPs or TFSAs beyond your down payment, you might qualify for a high net worth program. These programs can waive GDS and TDS pretty well completely. As an example, I recently worked on an application where one of the clients was in between jobs. Their income didn't support the mortgage they wanted, but they had 35% down and significant funds in their RSPs and TFSAs, so they qualify for the high net worth program. They didn't have to pull out these RSPs or TFSAs. The lender just wanted to make sure they had enough to cover the mortgage. If you're going to take one thing away from this video, it should be this: work with a mortgage broker like myself. We don't just look at your income or debts, we examine the full picture, including all supporting documents to structuring your mortgage application the best way possible. Mortgage calculators are a great quick snapshot, but they don't replace expert advice. Download my Mortgage Toolbox app to find your baseline, and then reach out to me to get your personalized pre-qualification. Remember, banks only offer their own products. We have access to an extensive list of lenders and products to help you stretch that qualifying power. Thanks for watching. If you found this video at all helpful, give it a like, subscribe to my channel, and share it with somebody who is starting their home buying journey. If you have any questions, drop them in the comments or feel free to reach out. I'm Dylan Kelly, and see you in the next video. Peace.